Hey there, future CPAs. Welcome to This Explainer. Look, if you are a Gen Z accountancy student grinding away right now trying to make sense of Philippine tax laws, well, you're in the exact right place. Our goal today isn't just to, memorize some facts for tomorrow's quiz. Oh no, we're aiming for that sweet 3-year long-term memory retention. We want it so that when you finally sit down for the actual LECPAN a couple of years, this information is instantly accessible. Now, I know the rules for taxing different entities can feel like a totally tangled mess of exceptions, but today, we're going to hack your brain's filing system. We're taking this incredibly complex topic and chunking it down into easily digestible, highly visual rules. So, grab your coffee, put your phone on Do Not Disturb, and let's lock this in. Okay, let's dive into this. Here is your mental roadmap for today. First, GPPs, our tax-exempt professionals. Then, business partnerships, which we'll call the corporate twins. Third, joint ventures and their exceptions. Fourth, co-ownerships and avoiding tax triggers. And finally, we'll wrap up with some LECPA hacks and a bullet review. All right, jumping right into our first mental bucket, GPPs, the tax-exempt professionals. So what exactly is a general professional partnership, or a GPP? Well, it's formed by persons for the sole purpose of exercising their common profession. Think of a law firm, or, very soon, your own CPA firm. Because a pure GPP does not engage in a traditional commercial trade or business, the entity itself is totally exempt from income tax. Instead, that tax burden passes straight through the entity and lands directly on the partners in their individual, separate capacities. Zero. Literally 0%. I want you to mentally burn this giant zero into your brain right now. When the LECPA asks you for the corporate income tax rate of a pure general professional partnership, the answer is an absolute, undeniable zero. The GPP pays nothing at the entity level. Now, sure, the partners are going to pay regular income tax on their individual share, but the GPP itself? Zero. Now, what's really interesting about this is how the BIR actually collects that tax from the individual partners in advance. We call this the Creditable Withholding Tax, or CWT. To hack your memory for the exam, I want you to remember the 3 million divide. It's super simple. If a partner's cumulative share of the income for the year is 3 million pesos or below, the withholding tax rate is 10%. But the absolute second that share breaches the 3 million peso mark, bam, the withholding rate jumps to 15%. Memorize the 3 million divide, and you'll absolutely nail any GPP withholding question. Okay, moving on to the optional standard deduction, or OSD. Guys, this is a classic LCPA trap, so pay close attention. The absolute golden rule here is once only. A GPP and its partners can only avail of the OSD one single time. If the GPP claims the OSD to compute its net income, the individual partners cannot claim OSD again on their distributive share. Examiners love to trick you into double deducting. Actually, scratch that. They completely expect you to fall for it. Plus, the partner's options depend strictly on how the GPP reported its income. If the GPP already deducted expenses to arrive at net income, well, the partner's share is already net of costs, so they definitely can't claim OSD on that share. Just remember, absolutely no double dipping. Moving right along to Section 2, business partnerships are corporate twins. And this brilliantly illustrates our contrast framework for the exam. Let's violently shift away from what we just learned. We have the GPP we just mastered, exempt from corporate tax, partners pay regular individual tax. But look at the business partnership. Under the Philippine tax code, ordinary business partnerships are considered corporations. They are taxed exactly like ordinary corporations. That means they pay regular corporate income tax, and when the partners receive their distributive shares, those shares are not treated as regular income. No way. They are treated as corporate dividends. Honestly, confusing these two is the easiest way to fail a taxation quiz. So because those distributive shares in a business partnership are treated as dividends, they're subject to a final withholding tax. Here are the specific rates you absolutely need for your mental cheat sheet. If the partner is a resident or citizen, the final tax is 10%. If they are a non-resident alien engaged in trade or business, an NRA-ETB, it's 20%. And for a non-resident alien not engaged in trade or business, an NRA-NETB, it jumps up to 25%. Always remind yourself, business partnerships are corporate twins, so their partners are taxed exactly like corporate stockholders receiving dividends. All right, part 3, joint ventures, the exceptions. Let's set up your default brain setting here. Whenever you see the words joint venture or consortium on a LECPA problem, your default assumption should instantly be taxable corporation. Generally speaking, joint ventures are subject to corporate income tax, exactly like the business partnerships we were just talking about. If two companies team up to sell shoes together, they are taxed as a corporation. Simple as that. But examiners, they don't just test the general rule. They absolutely love testing the exceptions. The government wants to encourage nation building, right? So they grant tax exemptions to very specific joint ventures. If the JV is formed for construction projects with licensed local contractors, it's suddenly tax exempt. If it's formed for energy, petroleum, coal, or geothermal operations under a service contract with the government, boom, tax exempt. So if you see highways or oil drills with the government mentioned in the problem, immediately flip that mental switch from taxable back to exempt. Let's look at part 4. Co-ownerships and avoiding tax triggers. So what's the baseline rule here? Simple co-ownerships are completely exempt from corporate tax. Think of them like accidental partnerships. Picture this. You and your siblings inherit a parcel of land from your parents. You rent it out and split the income. You're just co-owners. The entity itself is not a corporation, and the rental income is just taxed separately to each individual co-owner based on their share. It's safe, it's simple, and it's exempt. Let's move on and see how this builds, because this is where the BIR steps in. The examiner will absolutely try to trick you by starting a problem with a simple, exempt inherited property, but then the co-owners do something that accidentally transforms them into a taxable business partnership. So what exactly is that trigger? Here's the exact scenario you gotta watch out for. Step 1. The co-owners keep the property undivided for an unreasonably long time, usually beyond 10 years for inherited estates. But the real smoking gun is step 2. Instead of just safely splitting that passive income, they take those profits and reinvest them into a common business venture. The very moment they start acting like business partners trying to grow a commercial enterprise, step 3 happens. The BIR pulls the trigger, and suddenly they are classified as an unregistered partnership, completely subject to regular corporate income tax. It's a huge trap. Okay, bringing it home with Section 5, LEPA hacks and bullet review. So the crucial point here is that you need a mental filing cabinet. On exam day, you just don't have time to second-guess yourself. If the problem mentions a GPP, an untriggered co-ownership, a construction JV, or an energy JV, you instantly toss it into the exempt drawer. If the problem talks about a business partnership, a general JV, or a co-ownership that reinvested its profits, you immediately slam it into the taxable drawer and apply corporate rates. Mastering this simple sorting mechanism is going to save you so much time. Let's do one last rapid-fire visual rate check so these numbers are etched into your retinas. Over on the left are exempt pure professionals, the GPP Creditable Withholding Tax. Just remember the 3 million divide. 10% if it's 3 million or below, 15% if it's above. Now on the right side are corporate twins, business partnerships. Their distributions are final withholding taxes on dividends. 10% for residents, 20% for NRE ETB, and 25% for NRE NATB. Keep these two totally separate in your head. Okay, I want to leave you with a provocative thought to really test your new knowledge. Imagine you inherit a commercial space with your sibling. At first, you're just safely splitting the rent. But then, you take last year's rent money, you go out and buy espresso machines, hire some baristas, and open a trendy new coffee shop in that space together. Based on absolutely everything we've covered today, are you still just a tax-exempt co-owner? Or did you just pull the trigger and become a taxable corporate twin? Think about that reinvestment rule. Keep that active recall going, trust your mental filing cabinet, and you are going to absolutely crush your taxation quiz. Until next time, keep studying smart.